welcome to the Wednesday edition of Forex Focus. I was almost jumping into my previous life of splashing the futures. Look at me. Want to talk a little bit about Forex markets today. It's an incredible amount. We had quite a ride yesterday in terms of activity, and we're seeing it play through right now in real time. So Chinese just announced they're rolling out another 50% of tariffs on U.S. products. So they're taking their 30%, adding another 50%, up to 84% on all U.S. goods starting April 14th. With that, we saw U.S. equities, which have been struggling to stage a little bit of a rebound, get slammed. U.S. Treasuries continue to get beat up. We have gone from, in the bonds, 122 down to, last night I think we printed sub 112 briefly before bouncing back into the mid 114s. But that is a huge, that's almost breaking the 5% bound for long-term debt. And remember, so the reason I mention this is a couple of things. We know we've been talking about the correlation of bonds to the Japanese yen. Also, we're seeing U.S. Treasuries move in a very unique way. We're seeing the long end of the curve, ZB primarily, and ZN getting sold very hard. Those yields, those long-term yields, are rallying very quickly, while the two-year yield is actually falling. So we're seeing the yield curve steepen, but this is not what we traditionally tend to see in a risk-off environment. We see what we saw Thursday and Friday. And Sunday night, we see bonds become that safe haven play where we had traded 117 up to 122 very quickly, to give that all back on 2 days where, yes, we had a rally yesterday morning in equities that lasted till about midday. Selling emerged and accelerated overnight, and just accelerated again. With that, we saw bonds not rally like they traditionally do, bond yields fall, but we saw bonds continue to get sold. Now, why? There's never just one thing. There is talk the Chinese are selling U.S. bonds. There's talk there's going to be more borrowing to be done to finance the budget, whatever it is. For me, the disconnect, which makes me become a little bit guarded, is the amount of selling that took place in the long end, ZB, the 20 plus 30-year long bond, we call it, has been unrelenting, one-sided, and completely disconnected to the rest of the Treasury curve. So something's going on where either an entity or a country or a group of individuals is having to liquidate a lot of bonds. So does it speak to stress in the system? Maybe. You guys know the last thing I am is a conspiracy theorist, so I don't want to run down any rabbit holes, but it is a very disconnected piece of behavior. So we saw that come out. We saw, again, the U.S. put in place the full tariff suite on the Chinese. The Chinese just announced their tariffs about 30 minutes ago. And that's where we saw the reaction in U.S. equity markets. Now, the bonds, again, sitting somewhere around ZB right now is sitting, where are we? 113.18. So no big bounce there. We're still 2 full handles lower on the day after falling almost 7 handles yesterday. It's a big move. 9 handles from 122 to 113. Really 112 is a huge move in a couple of days in U.S. Treasuries. So let's take a look at a couple of our markets. Now, what we're seeing a little bit is a little bit of consistent dollar weakness across all the dollar pairs. And we're going to go through that a little bit. And the thought being a little bit of, we have seen the Japanese come out last night and talk about continuing to hike rates. We look at a currency that continues to trade a little bit lower, but the one thing that we're seeing, which is a little bit disconnected, we're seeing a higher yen or a lower dollar yen with lower bonds. Now, we've been looking at this over the previous 2 weeks, and we've picked up on the correlation that tends to be on an up bond day. i.e. yields are lower, dollar yen tends to get sold. When yields are higher in the U.S., bonds are lower. Dollar yen tends to get bought. We saw that play through all through this end of March, last 2 weeks of March, start of April. We saw that really work through. What we're seeing now is a complete disconnect from the long end of the market to yen. So we talk about correlations come and go, and they are things we watch and we're mindful of, but this correlation seems to be in the short run broken. So the fact that the bonds are down 2 points today, given our previous discussion, you would say, oh, at some point, this downtrend in yen to 140, sub 145, that's got to be an interesting place for me. If I want to be a little bit of the range trading contrarian and pick up something that is getting marked down, that might be an interesting play right now. I think, again, there's always a confluence of effects driving markets. Yen acts traditionally as a flight to quality. So we often see in times of stress, dollar yen being sold. We didn't see that play through at the start of this down move, but we're seeing it play through now. And the interest rate piece, the difference in rates between the two nations, isn't necessarily playing into the same fold here. So this is a case where, yes, dollar yen is being sold pretty aggressively. We're almost down 1% on the day. But I am not taking it of the mind that I'm that interested in necessarily picking a bottom down here. And we take a look at the hourly, and that move all of yesterday and today has been pretty consistent. And remember, when we look through yesterday's action, dollar yen selling took place. And remember, in the morning, at this point, 10 o'clock in the morning, U.S. equities were on a tear. I think NASDAQ was up 400, the SPUs were up 150, and there were still sellers in dollar yen. NASDAQ and NASDAQ and SPUs collapsed at the end of the trading day. There was still selling in dollar yen. Little bit of a reprieve overnight, very quiet, and then more selling takes place as U.S. equities release again on the Chinese tariff news. So we talk about, typically, we've talked about setups. You look at this. This is our, 1, 2, 3, 4, 5, 6 time at roughly 145, and each time we've pierced it. But that piercing has lasted, again, these are hour count, has lasted less than an hour, and we've recouped to trade a little bit higher. We are not seeing that right now. So now you could argue, though, we're seeing another piercing of it. If it doesn't last for more than a day, maybe this is an interesting range area. It could be for that contrarian, but I think some of the things I look at that have worked over the last couple of weeks, if not months, are a little bit disconnected now. So I'm a little less inclined to trust that this 145 value level will hold. So I'm going to be a little mindful to watch how the tape action unfolds today, and whether or not we're able to pop our head back above 145. Because if we do, then this is basically the same thing where we spend a little bit of time below it, not much, and we're able to base from that. But we're going into the start of the day below 145, not by much, 16 pips. But if we end up continuing to plumb this lower end of the range, I would be very mindful at that point that the contrarian in me that wants to buy this 3-handle, 4-handle pullback, it may not be the right play. So we're going to keep an eye on that as we move forward during the week. Sterling, obviously off that spike high of 132, but we're seeing a little bit of a bid come back into sterling, into euro. Now, if you're thinking, and we're seeing it play through a little bit stronger in euro, back up to 111.62. So not quite at those highs we were at last year, but we're getting back to that level. Euro is, again, the second most traded in terms of volume and liquidity. When we talk about sources to go shelter in a storm, so to speak, the dollar's always been thought of that. It's a deep pool of liquidity. It's a relatively stable environment. If That stability is getting questioned right now by the markets, and they can be harsh in their questioning. Wouldn't be surprised to see, yes, we're seeing that play through with dollar yen selling. People want to be long yen. I think we may see a little bit of that play through in people wanting to be long euros and sterling for that matter. So we may see, from a tape action standpoint, this had a decent pullback from its highs. And we are now getting in a position to possibly start to challenge those old highs above 112. So this continues to be an interesting market that gives us two-sided action, which is great, and outsized range. I think last time we took a look at the 30-day one standard deviation move, we were out to about 52 pips here. We're already 83 pips higher on the day. So we're already through that and actually had traded higher a portion of the, let me get out of my daily to my hourly. So we've already had a nice run today, all the way up to 110.60 before we came back down to this 110.40 level. But from a structure standpoint, we're putting in new highs. We've kind of got to the upper end of this congestion range. The lows we put in are not anywhere near challenging old lows, and we seem to be building a little bit of energy. We know this can turn. Last time we saw tariffs announced, Euro, Sterling, Canada, Aussie, Kiwi, all got hit. Some of them bounced back more than others. Now we just had another round of tariffs announced and put in place. The U.S. to China, and China back to the U.S. We didn't see that we saw the time it was announced right at 6 o'clock. Euro downticked 15 pips, Sterling downticked 20 pips, and it was not 100, not like we've been seeing 110 pips. Tiny pullback that was immediately met with buying. So the idea that this escalating war is going to continue to weigh on FX, I think that's starting to get challenged a little bit by the market. So we're going to see how that plays out and plays through. Let's take a look at the commodity currencies, because if we go back, and let's just look at our all FX pairs. Very different story for Aussie. Let's take a look at Aussie right now. Again, up 28 pips, so nowhere near the 85 pips in the euro. We are off the lows. We know we plumbed new lows yesterday at 59.13. With the tariffs announced, did we see a pullback? A bigger pullback in Aussie, 45 points versus the 15 or 20 we saw in sterling. So I still think this is a case where Aussie and Kiwi are both bearing the brunt of this. And yes, they are. I mean, when we look, and you don't see a lot of this, guys. Let's go back to the daily for context. Here's our Aussie daily chart. Here's our euro. We're seeing something that is, on the euro side, starting to challenge the upper end of the long-term range. If we go back, let's get out of the hourly, go back to the daily for context. Starting to challenge those multi-year highs at 112, where in Aussie, we're seeing the absolute opposite thing take place. We've taken out lows, multi-year lows, and we're not seeing a lot of relief here. So the pairs trader in me, the contrarian, thinks, well, I want to buy what's cheap and I want to sell what's rich. I want to buy some Aussie, I want to sell some euro. I'm not quite ready to do that. Is the spread in these highly correlated FX pairs, we know they all correlate well when dollar is part of the quote currency or the base currency. This is a dramatic divergence in that. We can take a look at Kiwi and see, even to the same extent, that same divergence. Now, here's a Kiwi daily chart. Not quite as technically damaged as Aussie, which is clearly through the lows. Kiwi sitting around these lows here that we had put in, 55.30, but neither one of these markets is taking whatever you want to perceive as good news or dollar bearish news and rallying with it, but they're certainly taking any bad news and leaning against it. So as wide as these spreads are, if you look at the value of sterling to Kiwi or sterling to yen, euro to Aussie, sterling to Aussie, and we can look at those crosses in a little bit. None of them necessarily speak to me that that's a pair I want to start building on now, non-dollar crosses. I think for me right now, the focus is staying in the dollar pairs twofold. The liquidity is the greatest there, and I don't think these crosses are ready to turn around. We could take a look at them, and let's just look at, we'll go ahead and track down Euro Aussie here. So, as you would expect, when the contrarians out there look at this, I mean, this is a market that's run almost 20 handles. It is a huge move in a pair that has sat basically between 160 and 170 for almost 2.5 years. So an outsized move. So when we talk about, well, Pete, how do you know Euro is outperforming Aussie? Well, you can see on the chart that one's at the top end of its range and one's at the bottom. But what's great about FX is you can go right to that source and you don't have to do math and figure out, well, what is the ratio and everything. You can go right to the chart. And with 80 FX pairs, this is what I love, is the ability to look at these relative performances of these different currency pairs. Here, Euro Aussie is just taking out the dollar component. So it's a relative value of the Euro to Aussie. And this is a huge, almost 12+% move in the matter of a week and a half. Think about that in currency, which on average over the last 30 years, average FX moves in major FX pairs is 2.5% per year. That's the average. Sometimes it's more, sometimes it's less. That's start of the year to the end of the year, going back 30 years. So when I look at something that's moved 12% or 6 times that average in the matter of 7 or 8 days, it's an interesting extreme for me. I want to see, from an extreme standpoint, the pair is very, very interesting. I want to see how this plays out a little bit. But if you are that long-term structural contrarian, starting, number one, everything we're trading smaller size right now. We want to weather the randomness of these tweets. And again, if there's supposedly there was comments coming out this morning that there's good progress and a good announcement coming from Japan, South Korea, and Vietnam. Who knows what that is? Who knows if it'll have an effect? But we're all subject to these tweets giving us outsized movement, basically a day's movement in the matter of 30 seconds. So how do you handle that? Do you stop? No, you stay engaged, but you start and stay smaller. So if this is something that's interesting to you, this is something you can start by scaling into a little bit. Now, putting on some Euro Aussie is great because you don't have to weight the pairs. We do that for you. It's all there. The platform is fantastic about visualizing it and let you participate in it. You can start to layer in small shorts if you like the extreme. Again, you could have liked this at 180 and it continued to go right. Can we go to we're at 185 now. Can we go to 190? Sure. These markets are not bounded, but statistically speaking, we tend to see these non-dollar pairs have a greater reversion aspect to them than the dollar outrights. So what I'm saying is non-dollar pairs like Euro Aussie or Euro Yen or Euro Sterling tend to have more of a reversion aspect to them than Euro USD, Dollar Yen, or Sterling Dollar. So given that, 185 to 190 is an interesting area. Now, what I like about this from a trader's perspective too is I could take this extreme, and if I find it interesting, I could start to layer in a little bit of short Euro Aussie here and put a small amount in, kind of layer, let the market come to me a little bit. Don't be in a rush in this environment to use market orders. Let the market come to you and get paid, and do things incrementally. Don't put everything out If your usual lot size is 1 lot, or let's say your usual lot size is 5 lots, max position sizing should be around 2.5 right now, just so you can weather the movements. It is something like that. If your max lot size is 2.5 per pair you're trading, maybe you're layering in at half a lot at each 10 or 15 pips. You're working your way in with the idea of, I'm going to layer this trade in, and then where am I going to manage it? If it prints for 190, I'm going to cover it, or I'm looking for a reversion back into something sub 180, 175-ish. What's great is you can put this on, leave it alone. Obviously, you've got your risk parameters set, but it doesn't prevent you from then going back in and trading Euro USD or trading Aussie USD. They're separate pairs, and they'll be on the position, on your positions tab in separate pairs. They'll be P&L'd separately, so you will be able to take advantage of those two pairs without it necessarily impacting whatever your assumption is around Euro or Aussie for individual scalping ranges, which is great. So easy product construction, easy ways to express an opinion. And guys, today we just touched on the dollar majors and one currency cross. And you can see we're living in a time where it's really, these are unique times because I have not seen divergences like this take place. And we know the backstory. We can attach Aussie's closely aligned with China. That's their primary trading partner. China's hurting. Aussie's going to hurt. And Kiwi closely aligned to Australia, and that pain kind of translates across the water to New Zealand. Sure, that's part of the equation. The New Zealanders also lowered rates by 50 basis points to 3.5% yesterday. So they're continuing to soften their interest rates. Does that have a little negative bearing on the currency? Sure, in a vacuum. But remember, we don't trade in a vacuum. All these different things come into play. The markets price efficiently. We accept that. But within it, we find opportunity. And there's lots of opportunity here. And what I really like is the ability to be able to construct different sets of extremes and play both. You have the wonderful opportunity now to be both the contrarian and the trend follower, depending on the pair you're trading and the way you're trading it with it. So lots of opportunity out there. We'll continue to gauge with you around markets and continue to call out and highlight some unique non-dollar pairs that are interesting to trade. So thanks for joining me today. Coming up next is Tom, Tony, and Vanetta, and we'll see you back here tomorrow.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're #1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than, boom, trade like a trader.